Welcome to Shark Cap Table Lite. Make a deal and keep your arms and legs. It is about one round of equity and royalty financing. We're going to show the help. You could hide it if you wanted to by coming down here, but it's really a good idea to show the help. You could call your investors sharks, or you can call them investors, or you could call them VCs. I prefer shark. It's more fun, but when you write your documents, make sure that you put back shark or take shark out. And over here we'll tell you that you've set up Lite. Remember, Lite communicates with fast and vice versa. And it needs to be sell shares, and that works in Lite. Now along the top here we have a spin button, and you can go through a series of helpful hints. And one more thing, if you scroll over to the right here, you'll see some default settings. Read those and learn about them. They're very straightforward. They pretty much have to do with fast being set up the right way. Okay, so here we go. We've already set up a $1,000 investment for the Founder 1, and Founder 2 is the same. Each get issued 1 million shares. We have one option holder who puts in $500 and is issued $100,000 sometime in the future. So now let's take a look at the yellow, which is the totals. We've got 2.1 million shares outstanding at a cost of $2,500. Now notice that when you click on some of these headings that you get a pop-up, and you can move that pop-up to keep it out of the way. Let's go on down and continue. The next thing we need to do is an option pool. Professional investors almost always want an option pool to reward future managers. It is important that you just don't pay these people, but that you give them an important stake in the company. They'll work harder and faster and better. Anyway, that's what the professionals want. And by the way, it does dilute your interest. It does not dilute the investor interest. That's one of the reasons they want you to put it in. It's insurance against failure. So let's put in, and you can read over here, let's put in a 20%. There we go, 20%. And notice the red logic on the side here will give you an idea of whether or not you're in the right range. Let's crank in a little cost, $400, not much. Let's come on down here to detailed founder valuation. Now, investment in founder shares, section A, lines 1 through 5. There's the $2,000 right there. Now we have another line item, no additional cash invested. We'll get back to that in a moment. Let's go to the detailed founder valuation, which is a tab that's colored red right here. And here there's a lot of detail on the founder valuation. Here's the cash, remember the $2,000. Well, you could put some pre-money revenues. We'll put $10,000 in. Proprietary idea, let's give that $50,000. Patents, let's give that $125,000. Chief Executive Officer, we got a couple of good ones, so let's give them $100,000. Another technology officer, $100,000. These are not salaries; these are just what they bring in terms of total worth. And we've got the ability to capture market share, another $100,000. These are highly subjective, but it's a good idea to go through this. It's a good exercise. And let's say we have other considerations. Let's say we got some special relationships. We'll give $50,000 for those. So we've got now $537,000. Let's return to Lite, and presto, there is the amount, $537,000. The reason it's red is we have yet to put in the shark pre-money value. Now remember, this is what we think we're worth. Total sharks will never agree to that. If we're lucky, we might get something like $400,000. It depends on how good you are in this section to defend why you think the company is worth $537,000. We will put in $400,000. And by the way, this thing here is the big one that sets up the price of the shares, the number of shares, and ultimately how much of the company the investors get. So this is the thing that you'll be negotiating and moving around. Let's say we want to get $300,000. So let's put in $300,000. That's the investment sought from the sharks. And there we are. So we have a post-money value, which is simply the addition of pre-money and shark cash investment. Okay, we're moving right along. Now we've actually struck a deal, or at least structured one. We don't know it yet because I'm going to get down to that in a moment. Let's set up an exit value. Let's say we think we can get $2 million for this company. Now I'm going to show you something else. Let's move this little guy off to the side here, and I'll show you something else. We have some yearly revenue projections. We've already got this set up for the interest of time. And now we can come to this spin button here. This is kind of neat because you can then show graphically when you're going to be selling. And let's sell in year 4, right here. So year 4. And that means that $2 million is 2 times the revenue. So that is the exit values expressed as a multiple of revenues. There's the 2 times. Now, if you think you're going to sell in the future, you're going to have to go and raise this to get back to 2 or 2.5, whatever you think is fair. There's a lot written about this in the literature, but it really depends upon growth. And let's set that back to year 4. Now, right here it says that the shark share is 42.9% of the exit value. If the exit value is $2 million, this is what they would get at closing. Now, I want to bring your attention to this. This just simply says that it is an equity deal structured in Section D. Well, we're going to go to Section D and see what we can do next. Here's the equity deal. Let's scroll down a little bit so you can see it. Equity deal. Well, there's the equity investment, the shares issued, the price per share. Here's the shark pre-money value. We're going to exit in year 4. This is the shark share, and this is the total return. Now, the 3 key ones here are the multiple of 2.79 for the investment multiple, 30% internal rate of return, and the sharks own 42.9. I'm a little bit concerned about 42.9 because that's an awful lot of the company to give away for a modest $300,000. And the dirty little secret is almost every business needs more money in the future, so you have to be very careful about future dilution and control issues. Let's see if we can whittle this down by using a creative form of financing called a combo deal, which actually is a royalty, which is here, and we take the equity and put it into the combo. So, without further ado, let's do a preferential multiple. If you forget how it's done, look over here. This is the set of instructions. First, come down here, and let's roll in about 3. That means we're going to give him 3 times a target rate of return. Now notice we've got red lines or red conditional formatting. That means you got to do something. And notice as soon as you click, it disappears. Let's give them a preferential sales royalty of, let's say, 8%. And the last thing we have to do is we have to ascribe a target. Let's give them a $60,000 target. Now, look at this. 3 times 60 is $180,000. That means they're going to get extra in addition. $180,000. So we put it into the combo, and here we got the 180, and we've got a total return of $1 million based upon the 180 plus the shark share. Now notice what happens. We need to do another thing here. We're going to look at reducing the shark ownership, but let's remember it by coming over here, and using these little drop downs to kind of copy over these every time you got a little gray section, it's a little copy thing. And they're very handy, doesn't hurt the model any. You can always get rid of them. But now we've preserved this and this, this and this and this and this. We don't have to remember. We can just look over here. All right, so the next thing we're going to do is we're going to see if we can't reduce the ownership by virtue of increasing the pre-money value. Now, notice that the internal rate of return has gone up about 7 percentage points. So let's make this go up a little bit. That's a very slow one. We can come over here and make it a little bit faster until it gets down to 30. Whoops, we went by it. I'm going to then use this fine tune and get right on to 30%. There we go. So now these guys should be very happy. They actually get a little higher multiple, but they definitely get a good internal rate of return. Same one as before, but look at the difference. They used to own 42.9, now they own 32.4. This is really terrific. If you don't like this, you could sell an actual pure royalty, similar, but you would just come down here and hit the royalty deal. It's already done for you. But I like these combination preferentials. You could do another type of royalty, which is just a plain old royalty. But they go on forever. Investors don't like them. Preferentials get the investor in and out with a reasonable rate of return. The only thing is you have to be careful about assigning a big fat royalty without knowing the effect on cash flows. So before you do it, make sure you have some kind of a projection tool. Okay, so next thing that happens here is that we have agreed this is going to be a good possible deal. So the model is actually writing up exactly the terms and conditions. Here is the long-awaited capitalization table, and I want to move that little guy out of here. So you can see we have the four components of the capitalization with their respective exit values and their multiples and returns. You might see a notation over here that says huge internal rate of return. Well, that happens to do with the option pool that has a very small investment and a very large exit value. We do not include the price of exercising the shares in these calculations. Maybe someday we will, but we're not doing that right now. Now, this next table here is the summary of the founder shares and pre-money options without additional investment. Okay, so what do we mean by that? Well, it's just simply the founder shares, how much they paid for it, the investment, the shares, etc. I want to run back here and just alert you to another way of raising a little more money. We're not going to do it, but I'll tell you how we do it. Here we have only $2,000 raised. The investors are looking to put in $300,000, even though we have a pre-money value of $537. We really think that we might have to raise more money. And one way of doing it is simply coming down here and cranking in additional cash invested. Now, really what's happening with this number here is it's kind of like we're selling a little secondary to the founders. We each chip in according to our percentage ownership. So we'll set that down. You could also use this spin button if you didn't want to have the detail here. You could just come in here and just crank in, the $2,000 or $3,000, and that would work as well. We give you lots of choices because people like to have these founders and ability to raise more cash. All right, let's keep on moving. We're scrolling down here. So here we are. This would show the effect of that little extra secondary, the founder secondary. Now we get into some really fun stuff. This is the Shark Pitch Maker. We have 6 different types of businesses that we've written some descriptive sentences about fictitious businesses. Go ahead and laugh at it, but it was the best we could do at the time. So we've got software manufacturing service, internet distribution, oil and gas exploration. So let's take oil and gas exploration, something that we know a lot about here in Houston, Texas. So here's the name of our company. This is me. This is my good partner. And here we have a little sentence that'll be mixed up or concatenated, and we just want to make sure that we're talking about the same year as the sale. You want to make these numbers the same. Now here's what we've done. We've come in here and written these little gray areas, and what you're going to do, even though there's an equal sign here, you're going to break it and you're going to write something very similar to what we've done here if you're in the oil and gas business. If you don't want to be in the oil and gas business, well, be in some other business. How about the internet business? So there we have some internet marketing and information. Once we get all that together, we concatenate it into one big stand and deliver with all the numbers, which of course can be edited if you take it out and put it into Microsoft Word. And if that wasn't enough, we have one more goodie for you. We've actually taken all of this information and put it into a printable one-pager. There is one thing you have to do. You have to write the summary of opportunity. Now I'm going to revert back to the detailed founder valuation. I'm going to scroll to the bottom. We have given you 11 absolutely crucial questions investors want to know. If you can answer those reasonably, with honesty, you should be able to, I have to go to the exec sum, you should be able to write this summary of the opportunity. So assuming you can get past that, here is the little chart showing the revenue projections and the exit value. Here's the proposed offering and expected investment returns. We've reproduced the capitalization table, and there's that wonderful two-founder pitch. So there it is, folks. Now you know how to use Lite, Shark Cap Table Lite. Let us know how you're doing. Drop us some emails. If you get into trouble, maybe we can help you figure out something. But by all means, get this tool, get into it, and read it. And by the way, there's lots of help. Just click around, and you'll see all kinds of help coming from numbers that are colored blue in the major headings. This is not as hard as it looks. Take your time. It is well thought out. A lot of people have used it. They love this. Thank you very much.